people come to you to either use your services to sell the business or to use you to buy the business. And what you do for them is you prepare their business so that they can maximize the value of it for either for sale or for purchase. So that's the audience that I'm speaking to. So when it comes to business transition planning, when it comes to selling your business, this is a huge sector. Most businesses, all baby boomers right now, are starting their retirement, and most of them are selling their businesses. Here in BC, 40% of business owners are going to transition out of their businesses within the 5 to 10 years. So there's a huge opportunity to be able to make a difference for them. Now, when you sell your business, there's only two ways to sell your businesses. You can either sell it by your shares or by the assets of your business. So today, I'm going to show you two vehicles that you can use to minimize the taxes that you would have to pay and turn that into an opportunity to fund your retirement plan at the same time. So these two vehicles are, number one, it's called IPPs, Individual Pension Plans, and number two, RCAs, Retirement Compensation Arrangements. So I'm going to talk to you first about what they are, what they do, and then I'll tie it all in by how you can use that to pay less taxes and fund your retirement at the same time. So both of these vehicles are known as defined benefit plans. So for those of you who aren't familiar with pension plans, defined benefit plans are the same pension plans that teachers have, where the income that you receive is defined and predictable when you retire. So these plans are set up by the corporation, so it's set up by your company, it's funded by your company as well, and the contributions are tax deductible. So think of it this way. The corporation sets up an RSP for you, they fund the RSP for you, and it's a tax deductible expense for them to fund the RSP for you. How great is that, right? You don't have to fork it out of your own pocket. And these plans will also provide you with the highest degree of creditor protection. As business owners, you want to make sure that your assets are protected. So who are IPPs perfect for? Well, in this context, they're perfect for business owners. In order to qualify for an IPP, or individual pension plan, you need to be at least 40 years old and paying yourself a salary of a maximum of $135,000 a year to be able to max out on the contributions. For RCAs, there is no age restriction for this. If you're making at least $200,000 per year and you're 30, 35 years old, you can qualify for this plan. Now, the great thing about RCAs is that it's not exclusive. You can have an RCA and an IPP at the same time. However, with an IPP, you can only have one or the other. You can only have an IPP or an RSP. You can't have both. So why would people want to have an IPP and an RCA? Well, the advantages are, number one, the contributions are much more significant and substantial than RRSPs, and we'll get into that at a later time. I'll show you the differences that the contributions are. Again, the contributions are fully tax deductible by the corporation, so it's like another expense. It's like your corporation, you having a car under your corporation, and it's fully tax deductible. So this is another expense for your corporation to deduct against their taxable corporate income. Here's another great one as well too. You can contribute for past service contribution. So when you set up these plans, your corporation can put in a lump sum of money into these plans to get it started. And that can be quite substantial as well too. Again, you have the highest degree of creditor protection. Here's another one as well too. You can contribute for terminal funding. So upon retirement, and I'll come back to this, upon retirement you can contribute, or your corporation can contribute another lump sum amount of money into these plans. These payments, when you receive payments from these plans, it's eligible for pension income splitting. So that means that when you receive the income, you can actually allocate up to 50% of it to your spouse to lower your overall taxes. Last but not least, there are no minimum funding requirements here in BC. So again, it acts like an RSP. If you can't fund all of it right now, all the contribution room gets carried forward into future years for your corporation to use that. So lots of tax planning opportunities. So that's all theory. So let's put this into an example. So we have John Smith here, who's 60 years old this year. He's had his business since 1991. He's been employed by his business, and he's considering selling his business and retiring in about 2 years. So when we actually worked out the plan, again, for the past service contribution, the amount that his corporation would be able to put in for the IPP is $234,000. Now that's quite a substantial amount. Again, here in BC, there are no minimum funding requirements. So if the corporation can't fund the full amount right now, say they can only stock away $50,000 into this plan, the remaining amount gets carried forward into future years. And that's actually really important because when you sell your business, you can use that to offset the taxes at that time, taxable income. So for the RCA, again, you have to be making $200,000 a year to be able to contribute to this plan. But again, for past service, you can stock away $2 million. Like that's a huge amount that your corporation can deduct from the taxable income to put into a retirement plan for yourself. There's no other vehicle that's sanctioned by Canada Revenue Agency that allows you to do that. For annual contributions, IPP you can put away $36,000, $39,000, $42,000, RCA $88,000, $91,000, $94,000. Now for RRSPs, maximum that you can stock away right now is $24,000, and it increases by grand every year thereafter. So if you're a really successful business owner and you're looking to pay less taxes and fund your retirement at the same time, hands down, these vehicles will allow you to do that. Again, there are no other vehicles that are sanctioned by CRA that allows you to use your corporate funds to fund your retirement plan. So let's tie it all together. So how can you use these plans to offset the taxes that you would have to pay once you sell your business? Well, going back to what I said at the beginning, there's two ways to sell your business. If you sell it by assets, you're going to trigger a lot of taxable income, and there's going to be a significant recapture. So you have a large taxable liability here, okay, but you have, if you enact the terminal funding clause, which allows you to put away a lump sum of money for the sale of the business, you have a whole bunch of expenses here, and you have this taxable income here. So really what you're doing is you're redirecting the money that would go towards paying taxes into a retirement plan for yourself. Also, for when you sell your business using shares, okay, a lot of business owners that would have investment portfolios within the corporation. In order for those shares to qualify for the small business corporation shares, which allows you to defer, which allows you to not pay $800,000 in capital gains taxes, you need to purify that. So one way to purify that and extract the money out of your corporation in a tax-efficient manner is by setting up these plans, because it is an expense that goes right into the corporation like that. There's no other way to get money out of your corporation, okay, without having to pay taxes on it. And these are the two ways in which you can do that. It can shelter future investment income from the proceeds when you invest the business as well. And if you're planning to leave the country, this is another great way for you to use those vehicles to help you pay less taxes. So that concludes my speech right there. And thank you very much.
Thank you, Gilbert. A few of my people I know who are small business owners plan to work till they drop dead, literally.